we're live.
All right.
It's weird.
How's everybody doing?
Hello. Welcome back to Makeover Monday. We're gonna give it a few seconds. We're using a different upload. I don't know. Facebook changed things again. I don't know. Anyway, welcome. We're gonna give it just a few seconds to see if anybody jumps on, and then Adam is going to be teaching you guys all about investing tonight. And so, while well, not all about, but
just
the basics. Yeah, we can't go too far into it because we're not financial planners or advisors. So, I realize you can see the behind of us on that monitor back there. Let's get a little closer. Anyway, so if you're joining us for a replay, thank you for watching. We've missed you guys. We've been away for a bit. I've been doing some teachings on teenage finance. I'm still working on those. If you are interested in seeing those or have missed those, you can actually find those over on our YouTube channel, which is the same as our Facebook name, Break the Cycle of Coaching or Financial Coaching. So just look us up over there. We've got a couple videos. I try to do one a week on teenage finance, and then we're going to be changing topics. We have 2 more of those to go, and then we'll be changing topics. So as you hop on, please say hi. We'd love to know who's watching with us, and make sure you share it so other people can see it as well. And without further ado, here's Adam to tell you all about investing.
All right. Yeah, we're going to talk a little bit about investing, stock market, and brokerage accounts, retirement accounts, what have you. So the biggest thing with investing is a lot of people don't think they have enough money to do it. That's probably the number one obstacle that gets in anybody's way. But that's not true. If you've got money to play the lottery, you've got money to invest. So we're going to talk about a few ways that you can choose how to invest. All right, so you can open a traditional brokerage account, even a retirement account as well. You can do it yourself. You can invest in your own funds. You can invest in individual stocks, however you want to do it, but you're going to be doing it yourself. The second way to invest is you hire someone else to do it for you. They're going to pick your funds, they're going to pick your stocks, they're going to pick your portfolio allocation, and they're going to handle everything for you, but they're going to charge you to do that. And normally they charge a pretty hefty fee. There's different people, like Fidelity with us, they do our wealth management. They charge 0.35%, which is almost on par with a robo-advisor, which we'll talk about here in a second. But then you have people like Edward Jones that are going to charge you out the rear to invest your money, and they're not going to do any better than an index fund. They're going to do worse. They're going to do far worse. And that's just my own opinion and what I've heard. We don't use Edward Jones, but I would stay away from them if I were you. Also, so the third way that you can invest is through a robo-advisor. And that's just you automatically put your money in and they do everything for you, but it's a software algorithm. They're going to determine based on, I don't know how they do it, but you put your money in, they're going to buy a certain portfolio allocation. They're going to rebalance for you on the fly whenever you need it done. And they're going to make sure that your asset allocation is in line with your investment goals and your risk tolerance. So basically, when you sign up for one of these robo-advisors, like Betterment or Wealthfront, or I think Fidelity even has one now, you're going to be asked a series of questions when you open the account. And depending on how you respond to these questions is how aggressive or conservative your portfolio is going to be, what kind of different allocation that they're going to give you. It really depends. It's hard to say, but are you going to be investing in big companies like Apple and Microsoft, or are you going to be riskier and you're going to be investing in these smaller companies, or are you going to be like even more risk adverse, or are you going to be in bonds? So that's all stuff to consider when you sign up for these robo advisors, which they'll explain it as you go through the process, but it's just something to be aware of. So the good thing about a robo-advisor, you can automate your investments. So when you get paid, you can say, I want to put $50 into this account, and they're going to take that $50 out every week. You won't have to think about it. You won't have to do anything, and they're going to invest it for you. And there's no human interaction there. There's so you don't have an advisor with the market crashes, and they're worried about their fund looking bad and making poor decisions. You're not going to have any of that. You're just going to have software on a computer somewhere in the cloud, and it's going to do what it's going to do, and you have no control over it. Which brings us to the downside of a robo-advisor, which is you have limited choices. You only have so many funds, so many stocks that you can choose from. Usually you don't even get the option for individual stocks. You're choosing like a fund, and that's what you get. So, there's the good part of it, and then there's also the not so good part of it. So with a traditional account, you're probably more familiar with names like Fidelity, Vanguard, Charles Schwab, TD Ameritrade, and the newcomer Robinhood. Robinhood has kind of flipped the script on everybody in the last few years, which is the main reason why nobody charges you to buy stocks anymore. You can buy individual stocks. Like way back when I started in 2008 through USAA, I was paying pretty hefty brokerage fees of like $15 a trade. Even like going with the cheaper option, the E-Trade, is still pretty expensive, like $7. Now it's free, and that's all due to pretty much Robinhood offering, no cost stock trades, which is great. It lowers the barrier to entry. It's one more thing that you don't have to worry about, but everybody else found that in order to compete, that they had to do the same thing. So now, poof, there's no more brokerage fees for stock trades, pretty much anywhere.
So for me, like, I always picture the stock market like you see it in the movies, right? Like, you have to call this guy, and he calls you, and you say yes, you'll give him some money for a stock, and maybe it does good, maybe it doesn't. That's not the case anymore. I mean, you can have those. There are people that still do it like that, but you don't have to. Like, we've never talked to anybody like that. Like, nobody calls us to say, hey, do you want to buy this or you want to buy that? So I think a lot of fear from coming into the stock market is first of all trust, right? Because people kind of see it as this like shady thing that is, because from 2008, the stock market crash, like all those things, we see all these shady people like Bernie Madoff and like all of these scandals. And it's really not like that for most people. Like, if you're, have a ton of money, obviously you're playing bigger fields, whatever. Maybe it's like that for those people, but for like smaller investors, it's really not that scary of a thing anymore. And I know that's not, sorry I cut you off, but I just want to jump in there and say, for myself, for somebody who didn't know, who still really doesn't know much about it, that's why he's giving this lecture. It can be scary for me because it seems like gambling, and it does bad, but you don't want to see it do bad or whatever. You want it to I don't know, you kind of want to just hold on. So I'll let him finish, but I just want to jump in.
Well, I mean, yeah, let's go ahead and address the gambling thing right now, because okay, so if you feel like you're gambling, then you're taking too much risk. Mm-hmm. So in order, the easiest, not risk-free, but less risky way to invest in the stock market are what are called index funds. So an index fund mimics your S&P 500 pretty much. Almost all of them do. So if the entire stock market goes up 5.8%, your index fund is going to go up very similar, like 5.6 to whatever. It's going to be really close.
So,
and likewise, when the stock market goes down, you're going to see the same dip.
So what's an index fund exactly?
Index fund it's a fund. It's just a ton of companies that you buy. So, you go back 20 years, everybody is offering like mutual funds. Was the big thing. Dave Ramsey pushes on. When I first started investing, I got into a loaded mutual fund. So I had to pay to own, or just to get into this mutual fund, I had to pay like a 50% upfront charge, which I didn't know anything. I was like 20 years old at the time, and it's stupid. Like why would you do that today when you can get the same thing in the index fund? I say the same thing. It's a little bit different, but whereas a mutual fund, the fund manager is trying to beat the market. They never do. Like I think something stupid like 95% of all funds fail to beat the S&P 500, which is exactly why you invest in an index fund, and you're betting on the economy in that situation. So if you think the American economy is going to continue to grow, you don't want to take a whole lot of risk and invest in individual stocks, which is super risky. We'll get to what we're doing here in a couple of seconds, but we right now we are buying individual stocks. But going back to index fund, that is just drive it into your memory bank there. Index fund. That is, if you don't have any clue about the stock market and you want to make money in the stock market, you want an index fund. And kind of like we already touched on, when you buy one share of this fund, you're actually investing in thousands of companies in the U.S. economy, or there's other index funds like international too. But say that the S&P 500, you're investing in all of those companies, and the odds of the American economy going under is so slim that it's almost impossible to lose.
So to put it in basic terms and kind of give you something to consider it with. So you've heard the term, don't put all your eggs in one basket. Well, this is spreading, an index fund is spreading those eggs around to all different, thousands of baskets versus having all of them in one. Okay. You're spreading them out.
So it's like she's saying, that's called diversification. You're not just buying into one stock or one sector like technology or whatever in the U.S. economy. You're not just buying oil. You're just not buying one thing. You're buying a whole bunch of different things. So if technology tanks and it's underperforming, maybe energy is bringing it up, and it's a way to protect yourself.
And if anybody has questions as we're going through any of this, feel free to ask them. I am keeping track of all the questions and comments here. We can't see them on screen, but I can see them on my phone, and so we'll answer those as we go.
Okay. All right. So forgot where I left off now. All right. So let's talk about different robo-advisor companies. Betterment, they're one of the first ones that came around. They've been in business since around 2008, I believe. I think they started actually taking investments in 2010. So they're the bigger of the robo-advisors. Next you have Wealthfront, SoFi, and M1 Finance are all considered robo-advisors, or at least have robo-advisor services. And Betterment and Wealthfront, I think, only charge like 0.25% for their fees, which is pretty low. It's not the lowest out there. Again, if you want to go with like a Vanguard BTI index fund, that's the U.S. Total Market Index. That's Vanguard's product. I think their fees, or their expense ratios on those are so low, like 0.03 or 0.04%. It's ridiculous. And Vanguard continues to try to drive those fees even lower, whenever they can. So it's an index fund. We're invested in it. Even during this market downturn, we're doing stocks. I'm doing VTI index fund because I don't know if the stocks I pick are going to make it. I think they are, but we don't know, and we want to kind of protect at least part of our investment with an index fund. Okay, so there's beginner investor robo-advisors too, like Acorns and Stash. I would be really hesitant about dealing with either of those companies, and I say that because their fees sound super cheap, like $1, $2, $3 a month for Acorns, and I think Stash goes up to like $9 a month if you need custodial accounts um, for your kids. And it doesn't sound like a whole lot until if you consider someone who's only got like 100 or $200 to invest, then that $1 fee, you're looking at 1% or 2% or half a percent or however much money you have in there, and that's substantial as far as investing fees go. Because what you're looking like, we're talking about that index fund, 0.03%. I mean, that's almost nothing. And Fidelity actually has a zero fee index funds. So, if all you're looking for is, your fees, you want to get the lowest fee, you buy Fidelity's zero fee index fund. It's zero.
Now you're going to hear us talk a lot about Fidelity just because that's who we use personally. Adam in the past has used somebody else. We've used a couple of people before, but we now use them, so that's who we know the most about. We do encourage you, though, to do your own research and find out who you're most comfortable working with.
Yeah, so we're just telling you the stocks and funds that we're invested in. I do not have any of Fidelity's zero fee funds simply because Vanguard beats them. And, that's going to make up for that 0.03%. So there's more to consider, but if you know absolutely nothing about investing, it's a good place to start. Just so you can get your feet wet, dip your toe in the water, and it's going to take some time to maybe even convince you after you open an account that this is a thing that's going to make you money, because you're going to see it go up, you're going to see it go down, you're going to have patience, it's going to take a long time. This isn't something that you're going to dump a bunch of money in and then boom, you're going to be a millionaire. This is it's a slow way, but it's a proven way to move towards wealth. And the idea is when you get to retirement age that you're going to have a nest egg waiting for you outside of Social Security. You can live on Social Security. It's going to be tough if they don't cut it before then, which they're almost certainly going to have to at some point, because we're not going to be able to afford the payouts anymore starting like in 2034. And that could come sooner now because of this whole coronavirus thing. So keep that in mind. It's not something that we can rely on. It's not something that's guaranteed. It's just if the government has the money, they can pay it. If not, they're going to have to cut it or raise taxes. And politicians running on the raise tax platform, it's probably not going to get a whole lot of votes. So how do stocks work? How do you think stocks work?
That's a great question. So, me personally, I just always thought that you buy a stock, you buy a portion of a company. When that company does good, then you earn money. That's what I've always been. I think I've always taught or been taught or learned, or maybe I don't know where I got that from, but yeah.
How do you earn money? Well, I mean, even Monopoly,
Yeah, well,
you earn dividends.
You earn dividends, yeah. So like the company pays out certain dividends. Their profits go to their shareholders and the stockholders or whatever. I really don't know how it works, to be honest. This is why he's the guy, because I know nothing about stocks.
All right. Well, there are two main ways that you can make money with stocks. The first is you buy a stock. Let's say you buy one share for $5, and then 10 years later, that one share is now worth $10. Well, you made $5 on that one share. So you have stock appreciation, and is a main driver of the money you're going to make in the stock market. And if you go to any of these websites, if you Google S&P 500 historical returns, you're probably going to come across one or two websites where you can choose what year you want to start and the end year, and then figure out how much stock appreciation happened between those two dates. And it's going to give you like normally like an annualized return number, which is going to be anywhere from 5 to like 9% for U.S. stocks over since like 1926. You're looking at an average of 7% return, and that's just taking into account stock appreciation. Now, if we take into account dividends, that's the second way you can make money off of stocks. So if I buy that $5 share and they agree to pay me a quarter, every 3 months. So let's say it's unrealistic, but $1, it'd be 20% yield on that one share. Then every year that I hold that one share, I'm going to make $1, and that share is going to be worth whatever stock appreciation or stock depreciation occurred in that year. So as you build up your portfolio and you add more and more companies and shares or funds or whatever, you have the potential to build up quite a large number of shares. Some of them will pay dividends. Not all companies do. A lot of your major companies, they will. A lot of companies pride themselves on being able to pay out dividends year in, year out, raise the dividend every year. They just want to show their shareholders that they're looking out for their best interest, and they want to make the money. That's the main thing a business is supposed to do. And so we live in a capitalistic society, and part of capitalism, if you want to be part of the success of your McDonald's and your Walmart, instead of just going there and using their services or buying their products, that's great, but it's going to cost you money. But if you want to use those companies to make money, then that's where you use the benefit of capitalism that says you can buy a share of that corporation and they will share their profits with you. And I think that's a lot that gets lost on people quite a bit. And you see, even on the news, when the financial segment comes on, they're always talking about Wall Street. But no, it's not just about Wall Street, it's about Main Street. And if you're putting your money into these corporations, you're going to see the benefit of, of them being able to expand their business and, basically grow. And you want to be a part of that. So
there's a special guest trying to join us. Sorry, guys. Say hi. TV. Watch out, baby. So we have a question. Someone wants to know, out of the two ways, whether it's dividend or the original ways, which is the best way to make the money? So is it dividend stocks are better, or?
Okay. So let me tell you a bit of a horror story that we're kind of going through right now, and maybe that'll answer your question. So, right after the last market crash in 2008, I switched jobs. We got settled. About 2010, we started putting aside money into doing what we're doing now and putting it into individual stocks. And we built up a small fund of about $10,000. And I was investing in different companies and kind of thought I wanted to day trade. Didn't do horrible at it, didn't do great at it. And basically I just don't have the patience to go in there and research these companies, and especially offshore with the satellite connection and Wi-Fi, it's super slow. It just got kind of old. So I started putting that money into a mortgage real estate investment trust, and they're called REITs. And there's different kinds of REITs, but in the one that we were invested in, or still are, basically when they sell mortgages in the secondary market, these companies, these investors are buying them, and then they make money based off of the spread of the interest rate that they buy at, and then the interest rate that these mortgages are going for now, and they use leverage in order to make their money. So we started getting these pretty good dividend payouts, which is like 10, 12%, which is the yield is what attracted me to them to start with. And we started pumping those dividends back into the stock. So over 10 years, that $10,000 grew to like $22,000. You know, it's not bad for that size portfolio. You know, I didn't do any kind of diversification or anything like that. It was just one stock, super risky, pumping it back in, and it did great for a decade. And so now that was the dividend part of it. So the stock appreciation, remember stocks can also depreciate, which is exactly what happened. And so we went from, I had basically just broken even again with my unrealized gain loss. Actually, we were doing a little bit better than breaking even. And then that's not including dividends. That's just based on the prices that I was buying at. So it was up around $15 a share, and they dropped down to about, I don't know, $2.80 at their lowest. So that $22,000 is now worth like $3,000 or $4,000. It's unrealized gain and loss. Unrealized meaning we haven't sold it yet, so we still own the share. Now, a lot of that had to do with coronavirus, and you know, me not really understanding the impact that was going to have on that, which is okay. A good reason to consider a financial advisor if you need one. But you know, just be aware that stocks can go up and stocks can go down. But you're going to make most of your money off of stock appreciation. That's just plain and simple. Now, like VTI, the index fund I've been talking about almost the whole time, they do dividend payouts too. And so you kind of get the benefit of the entire stock market along with the benefits of dividend payouts as well. There's some people that's all they want to do is they want to build a dividend portfolio. They don't care if the stock moves that much. So like Walmart, for instance, Walmart's not going to grow that much more because Walmart's already huge. They've already saturated the market. They're everywhere in the U.S. So they're not going to. They don't have as much room to grow as like a Chipotle or Chipotle, whatever. Or you know, like a smaller company. So people will buy their stock because it's stable, and then they're going to pick up the dividend, and that's good enough for them. So if you can get like 2, 3, 4% dividend payout, then this is super distracting. Then you know that why not? That's the route that they chose to go. That's the 4 or 5% is good enough for them, and they'd rather have that income stream coming in than trying to go out there and invest in a riskier stock. So I hope that kind of answered that question. So you're going to make more money off of stock appreciation in the long run, but it's also nice to get the dividend to go with it if the company offers that. If not, you can, if you want more stability, you can opt for a lower gain through a dividend payout, and just kind of hope for that stability.
Yeah, but one of the good things about a dividend stock, I will say, versus the other kind of stock, just non-dividend stocks, not what they're called, would be this. So we had been putting aside some money with our dividends to save up to help our daughter get a car. Now, we are able to do that because we're getting these dividend payments and it didn't come out of our pocket. So if you have something that you're trying to fund and you really don't have the money, but you have a dividend stock, then you can take your dividends and you can put it doesn't have to go back into the stock. So it does open up some revenue streams for you if you have a good, decent, dividend. So it really just depends on your situation, I think. Obviously, the one that's going to give you more money, like you said, is the appreciation. Is it depreciation? You said? Did you say stock appreciation?
Appreciation, it means it goes up.
Okay.
Depreciation means it goes down.
Yeah. Okay. So yeah. So, but it really just depends on your situation and what you're looking for.
So, well, before all this happened, we're eyeing early retirement. I am. I want to retire early. I don't want to work until I'm 65. I want to work maybe until I'm like 50 or 55, maybe even retire sooner than that. But in order to do that, we want cash flow. We want money coming in from passively, or at least close to passive, and uh, dividends are part of that. So I would like, whenever I retire, for about, like a quarter of what we plan on spending that year to come from a dividend portfolio. You know, and we don't plan on retiring some kind of crazy number like 40,000 a year with no bills. I think it's great for us. So if we have this money coming in through dividends, hopefully about $10,000 a year, that would give us some options. So if we're retired, we're not going to work, and coronavirus 2.0 hits, then we don't have to sell as much of our stocks as we would to get that 40,000. We can draw some of that from our dividend portfolio, so we're not selling as much at a loss in that situation, if that makes sense. Or when times are good, we can choose to take that money and spend more. We can improve our quality of life. We can travel more. We can do whatever we want with it. Save it, whatever. And that's kind of my line of thinking as far as dividends go. Now, dividends can be cut. That's not a guaranteed thing. So with that REIT style I'm talking about with us, it was 40 cents a share prior to the downturn, and they cut the dividend, and then they came back out and said we're going to pay 5 cents per common share. And so just to give the investors something back, and they're trying to keep as much cash on hand to stay liquid for their business model. But you're going from 40 cents a share down to 5 cents a share, so that's a huge cut. So we're not going to get anywhere near the quarterly payout that we had been getting, but hopefully within the next year or maybe even 2 years, however long it takes for them to feel that the markets have stabilized, that they're going to start paying up those larger dividends again. Just like, because this stock was like wiped out. Like half of its value is gone. They're trading below their book value right now. But, it's just like that. Half of the company's cash flow, their ability to make money, gone. And with that goes the dividends. So your larger companies like Apple, it's probably not going to happen to. But they also pay out a much smaller dividend. So.
I want to take a second to apologize. I can no longer see your comments. My phone died. So if you have them, questions or comments, please leave them. I will make sure to get back with you guys as soon as we're done on live and I can see everything again. So you were going to tell the nice folks kind of what we've been doing with our stock stuff, right?
Well, yeah. I give a weekly update in the group about how it's performing and kind of a little bit about what we're doing. So we had some money sitting on the sidelines, and with our emergency fund, we decided it was too large, and we've told the story a few times now. So going back to the end of last year, before any of this even happened, we were like, we need to start doing something with this money. So we did. But when we saw the dip back in, what was it, mid-March?
February.
Early March?
I think it's February.
Late February? Okay. Whatever it was, stock market lost 20% of its value. So we're like, cool, it's a great time to buy. So we did. And we didn't put everything in at that time. We just bought a little bit. And then stocks went down a little bit more. We bought. Stocks went up. I think we bought. So, kind of, you can't predict the future, which is okay. But we were locked in at least to those 20% lower price, which is good. And then when stock market dropped down to 30%, we were like, cool, we're going to buy a little bit more, and we kind of did that, rode it all the way down. So then we decided, well, we're telling people to take their money and put it in the stock market, and it doesn't matter how much. So we're like, maybe we ought to do that ourselves and kind of prove to everybody that it's a viable way to invest. So we did that. And we did that right about mid-March, I believe. And so just on putting 50 to 100 bucks a week, if we can support it. I think one week I only put 25 bucks in. It's whatever we could do. We're putting it in the market because we feel like it's such a good time, and we've already seen like a $200 increase in that portfolio. It's only got like $800 in it, so that's like a 25% increase. And those numbers I'm going off the top of my head because I think like from last weekend is actually closer to 20. But still, it's in the ballpark of it's just money that made. It's like your money made baby money all on its own. It's just okay. So we're gonna keep this going until we get back up to where the stock market was before we start letting it ride, and then we're gonna let it ride for another year or two, maybe longer. If it depends on whether or not how things go and whether or not we need the money or not. And we also want to lock in our long-term capital gains rates. So in order to do that, you have to hold the stock for 1 year, 1 day. And then you're good with the IRS. If not, they're going to charge you higher taxes, which is the bad thing about taxable brokerage is you pay taxes today. So it's just something that we're going to track in the group, and we're going to let you know how we do. So where we put our big money in, where we bought in too early in the stock market, it's still showing a negative balance. I think I call that portfolio 1 when I do the weekly investment update, and it's down about 10%. And a lot of that is largely attributable to that REIT stock because I bought more of that at the wrong time, which is also why we're buying the index funds to try and balance that out. So
buying stocks is kind of like an after holiday sale, right? You know the stuff's going to be discounted. You don't know how long your stuff's going to be there. So it's all about trying to find it for the cheapest price you can and still getting it, right? So for example, after Christmas or even after Easter, let's say you want some really cool Easter decor and you see it's on sale at Walmart for 50% off the day after. You're like, perfect. I don't really want to pay that much for it though. I'm going to hold off and see your Hobby Lobby. I'm going to hold off and see if I can get it for cheaper. So then you wait a couple more weeks and you see, oh, it's down 75%. Let me go back in there. Awesome, it's still there. Perfect. I'm going to wait a little bit longer and see if I can get it just a little bit cheaper because I always go to about 90% off, right? So you go back at 90%. Oops, it's gone now and you can't get it. So it's kind of the same as you don't know when the stock price is going to go back up or when it's going to go down. So it's a guessing game, right? So that's the best analogy I can think of as to put it on it is if you're a shopper like me, it's when you're trying to find the best deal, and it's making sure you can get the best deal without giving up what you're trying to get. So
or
to give you an example.
Or if you're going to hold it for 10 or 20 years, the price you're paying today is going to be pretty insignificant 10, 20, 30 years down the road. So they say time in the market beats timing the market.
It's true.
And we are trying to time the market.
Yeah.
I want to put that out there and make that clear. We're doing what you're not supposed to do, but it's also a good time, we feel, during a recession because it's going to be hard to lose. Unless that business doesn't make it, which is possible. There's already been a few bankruptcies out there, nothing like 2008 yet, but if you're buying a Microsoft or an Apple or an Amazon's killing it right now. Tesla, we own less than half a share of Tesla, but it's making us money. And that's the other thing with these online brokerages now. you don't have to buy whole shares. You can buy fractional shares. So if you want to buy Tesla's like $750 a share. You don't need $750. You can buy in with $50 or $100 or however much, and they're going to give you a portion of one share, and that's what you get. So, but percentage based, you're gonna, when Tesla goes up 10%, that fractional share is going to go up 10%. So that's what you're going to own. And you can still make money off of it.
So let's do just a quick rundown. If I have knew nothing about the stock market, have never invested before, what are a few steps that I can follow to start investing today?
You can find a brokerage or a robo-advisor or whatever you want. It's not hard. If you can sign up for an email account, you can sign up for a brokerage account. Most of them come with apps that you can load on your phone. You can monitor, you can look at it every day if you want. You can, a lot of them have automatic investments. You can tie it to your checking account. You can manually transfer it in if you want. That's what I do. And it's, so when I decide I get paid on Wednesdays, and I go in there every morning before I go to work. I transfer $100 from my bank account that's linked to Fidelity, and or whatever I can afford for that week. 25, $50. I try to get 100 if I can, and I transfer that in to Fidelity, and it's magic. It's there right away, and then I can go ahead and trade with that, and that's what I do.
What would you say to somebody who says that they don't have money to invest right now, or at all, even with normal things as normal?
Well, I mean, that's, if you're playing the lottery, you have money to invest. I mean,
what about if they're not playing the lottery?
If you're spending $5 or $10, or well, you might have to give something up if you really want to take care of your future. But for most people, I think that you can come up with $5 or $10 a week. Just say, even if you smoke and you want to cut back 1 or 2 days a week to be able to put something in, as long as you're putting something in, and you want to be able to see the benefits of that investment over time. And sure, there probably are people that actually don't have, that their budget is spent on surviving and they can't do it today, but then you get a raise, okay? Or you change jobs, or you get a better job paying a couple of dollars more per hour. So why not put that raise towards your future instead of your improving your standard of living? I mean, it's really up to you. It's your choice on how you want to live your life. It's your money. I can't tell you how to spend your money, but if you want to be able to have your money make money for you and not have to work your whole life until you're 70-something years old, then you're going to have to find the money to put towards the future. Unless you just want to live on Social Security, people do it. The margins are tight. Even living a stripped down kind of life where you don't do a whole lot, it's still pretty tight just on Social Security. And keep in mind, Social Security might undergo changes in the future. We don't know how those are going to affect us. They might raise the retirement age. That's another option that they got. But we just don't know. So, but you can control is investments outside of Social Security. So.
That's good advice. So yeah, so like you said, pay yourself first, basically, right? So take a look at what you're spending your money on. Right now, I think a lot of people want to feel better, and so they're spending money on things to make them feel better, or to support other people, things like that. I think that's great. Don't forget about future you.
Take your haircut money that you can't use right now
and give it to
and put it in
stock.
Yeah.
But yeah, while you're supporting small businesses and you're supporting, local people and all the people that help, I think that's amazing. But also make sure you support your future self, because you might need it. And yeah, so I think is all you got.
Well, yeah, I just got one more thing. Okay. So back when I first started stock picking, before I found out about index funds, I decided I was going to try something, trading these unheard of companies on the pink sheets. It's a waste of money. Don't do it. Don't do any over-the-counter bulletin board. Just stick with big. If you're going to pick individual stocks, pick big giant companies that you know, like Walmart, that you go to and that you're happy with. And so basically, I tried the Hail Mary approach, and it's like playing Tecmo Bowl and the old NES. You run back 40 yards, you throw the ball as far as you can, and somebody catches it somehow. And that doesn't work in real life. So, yeah, don't do pink sheets or over the counter.
So one of the things that Adam does now is he asks me, who do I think we should invest in? And honestly, I know, and I admit this over and over and over again, I know nothing about the stock market. It bores the heck out of me. I go with companies that I like, that I hear things about, that I buy with, that I feel that I like what they're doing, things that I see other people in my life using, and I'll be like, what about this? And he'll be like, okay, well, why? And so I'll say, well, they have this, this, and this, and this. And then I'll have to go look up their stock portfolio and see how they did, and I learn a little something that's great. But my picks are usually on companies that I support. Apple. I love Apple products. Why not Apple? Everybody in America, not everybody in America, but like a large percentage of us use Apple products. Adam's not one of them, but you know what? We have their stock because a lot of people use their products, right? And they have really good products, and they're going to be around for a while. They've been around for a while. We use Amazon. We like Tesla's mission. Like there's Southwest, we have them because I'm like, I like flying them. They're a really good company. When things come back on, people are going to want to travel. And so I kind of pick my stuff based on that. So instead of trying to find these obscure companies, or if you're not comfortable doing all the research, buy what's familiar to you. If you feel confident in it, like you said, you use their products, use them. If you're not comfortable picking stocks, do index funds. That's great. If you want to learn more, there's a podcast that we listen to called Listen Money Matters. That's really good about talking about investing. And then there's a book by Tony Robbins that helps explain different types of funds and what index funds are very well. And it's called Money Masters the Game. And I'll go ahead and link that, the Amazon link to that in the group later tonight or tomorrow, so you guys can find that. There's tons of great information out there that you can learn from. Don't be afraid of the stock market. It doesn't have to be a scary thing. Just don't try to be like a master at it if you're not. Just start small and just build, even tiny little bits.
Index funds.
Index funds, yeah. If you don't do index funds, you know what you're doing. But even little bits of money that you can invest in the long run, if you invest $5 a month, it's not a lot at all, but over time, it's going to help, and it's going to be more, and it's going to help build. Hopefully you can do more than that, but if that's all you can do, start at $5 a month. Even if you have to put money aside into a little account until you have $50 to invest, do that. Just start investing today, so that way 5 years from now, you're going to be like, wow, that really made a difference. And I'm going to be putting together a YouTube slideshow visual thing for this as well. That I'll have some like actual examples of the pros and cons of each RoboFund, and we'll be doing more into that in the coming weeks, so be on the lookout for that. That's all we got tonight, guys. Thank you so much for joining us. If you haven't checked out our YouTube page, please go check it out. Subscribe so you can make sure you get all of the updated videos that we have going on there. We had started doing Zoom trainings, and they weren't really working out, so we've just changed it to where we're doing everything on YouTube. We will be putting things up on the website soon as well. But let us know what you want to see. I am going to be starting our business makeover Mondays in May. I know we were supposed to start those in April, but all the coronavirus stuff kind of messed us up. So I'm going to be starting the Makeover Mondays for businesses in May. So we will be talking about that. If you have anything that you would like to, any questions you have, or anything, topics you'd like me to cover, let me know, and I'll make sure to put a training together for that. Until then, I'll still be popping on here every Monday, just with different I'm not sure what we're going to talk about for the next couple weeks, but we'll get on here and talk to y'all about something. So let us know what you want to learn about so we can do a Makeover Monday on it. What do you need help with now? Do you need help with credit? Do you need help with debt? Do you need help with bill collectors? That could be one we could do. Maybe we'll do one about handling bill collectors next week. I don't know. We'll see. Let me know what y'all want to talk about. Thank you so much for joining us. We hope you guys have a really good night, and we'll see y'all soon.
Bye.
Bye, guys.